All right, let's dive right in. Today, we're breaking down a really powerful strategy for anyone who's looking for those nice, reliable dividend checks, but also wants to see their portfolio grow over the long haul. We're going to build a hybrid dividend portfolio from the ground up, using a super clear blueprint that you can actually follow. So, here's the big question, right? Can you really get the best of both worlds? Is it possible to build a portfolio that pays you a steady income right now, while its value also climbs for the future? Well, the answer is a big yes, and the secret is all in how you structure it. The strategy we're going to unpack is called the core sleeve approach. And to make it real, we'll use a $50,000 portfolio as our example. This will show you exactly how you can blend a stable, quality foundation with what we'll call a sleeve of hand-picked stocks designed to really boost your immediate cash flow. Okay, first things first. Every strong building needs a rock-solid foundation. For our portfolio, that foundation is going to be the Schwab U.S. Dividend Equity ETF, probably better known by its ticker SCHD. Think of this as the anchor of the whole operation, the part that provides stability and long-term growth. So, why SCHD? What makes it the perfect core? Well, for starters, it's incredibly picky. It only looks at companies that have paid dividends for at least 10 years straight and have really strong fundamentals. We're talking healthy cash flow and a good return on equity, which is just a fancy way of saying they're good at making a profit. On top of that, its expense ratio is a tiny 0.06%, which means pretty much all of your money is working for you, not going to fees. And here's a key feature for our strategy. It actually excludes real estate investment trusts, or REITs. That's perfect because it lets us add our own higher-yielding REITs in the next step. And here's the income you get from that core. As of late 2023, SCHD was yielding about 3.8%. This is our dependable quarterly cash flow that forms the backbone of the entire plan. It's solid, but we can do even better. And that brings us to the second part of the blueprint, the high-yield sleeve. If SCHD is the engine, think of this as the turbocharger. We're going to strategically add a small selection of individual stocks to really lift our overall income. And here it is. This is our sample booster sleeve. As you can see, it's a mix of 7 different companies picked for their big cash flows and because they give us some nice sector diversity. We've got telecom giants like Verizon, energy pipeline companies like Enterprise Products Partners, and even a couple of powerful REITs. Just look at those yields. They are way higher than our core, and together, they're designed to give our income a serious jolt. Now, you might have spotted a few specialized terms on that last slide, so let's do a quick jargon buster. A REIT is just a company that owns properties that generate income, like our Realty Income stock. A BDC, like Eris Capital, basically invests in small and medium-sized private companies. And that K1, that's just a specific tax form you'll get from certain investments structured as partners, like EPD. See? Simple as that. All right, this is the moment we've been building up to. We've got our core, we've got our sleeve. Now let's put it all together into the final $50,000 blueprint and see what kind of income this machine can really kick out. So here's our target allocation, a 55-45 split. That means 55% of our portfolio goes into that stable core SCHD. The other 45% gets split evenly across our 7 high-yield sleeve stocks. This right here is the sweet spot. It keeps our quality foundation firmly in the driver's seat, which gives us stability, but it still gives us a major income boost from that sleeve. Okay, let's run the numbers, starting with our foundation. That 55% in SCHD is projected to generate about $1,045 in annual income. That's our stable base. Now for the really fun part. The booster. Our high-yield sleeve is estimated to kick off another $1,542 a year. You can see how these carefully chosen stocks are really punching above their weight, generating more income with less capital. And when we add it all together, our $50,000 portfolio is projected to generate a total annual income of $2,587. That is the power of the core sleeve combination right there in black and white. So what this all adds up to is a blended portfolio yield of about 5.2%. Now think about that for a second. By strategically adding that high-yield sleeve, we have boosted our total yield from SCHD's 3.8% all the way up to over 5%. And we did it without taking on a crazy amount of risk or giving up the quality of our core. Of course, building the portfolio is just step 1. Now you need the owner's manual. So let's talk about the practical side. How to actually implement this thing and manage it for long-term success.
Here's a simple 5-step guide to get this thing going. First, fund your core. Get that SCHD position established. Then, start building out the sleeve, maybe in a few batches over time. Third, turn on automatic dividend reinvestment, or DRPs. This lets your earnings compound all by themselves. Fourth, keep a simple calendar of when you're going to get paid. And finally, just schedule a quick check-in every quarter to make sure everything's on track and rebalance if you need to.
Smart investing is all about managing risk. So a few ground rules. Don't let any single stock get too big. In our example, each sleeve stock is only about 6.4%. Don't let one sector take over the whole portfolio. You always want to monitor payout coverage, which is basically just asking, can this company actually afford to keep paying me this dividend? And maybe most important of all, have a clear plan for when you would sell a stock if things start to go south.
And this brings us to a really crucial piece of wisdom. Sometimes a super high yield can be a warning sign that a company is in trouble. This is exactly why our strategy isn't about chasing the absolute highest numbers you can find. Instead, it's about preferring those durable blue-chip companies that are just cash-generating machines. Quality always comes first.
So, we've laid out a powerful blueprint that balances a quality core with a high-yield sleeve. But the real takeaway here is that this whole thing is adjustable. You can dial the risk and the income up or down just by changing that 55-45 split to fit your own goals. Which really leaves you with the final question. What's the right balance of safety and income for you?